What's going on, everyone? Charlie here. We're going to take an in-depth look at the ADF facility again in part 3. We're going to take a look at the rules that were superseded by FINRA, some of the participants, amongst some other things. Now, again, if you want to follow along, this will be available in the description below for you to go to, and you can actually interact with the PowerPoint as well and utilize all the resources available to you. Now remember, last time we discussed the ADF rulebook and how the rules were superseded by FINRA. Today we're going to actually look into those a bit more. We're going to see, or last time we talked about how the rules were reinterpreted to allow for manipulation. Several reserved sections are in the rules, and also we talked about some comments left by investors warning of the dangers of the ADF reinterpretations to some of the rules. This time we're going to look at quantitative suitability, and we're also going to look at the rules that were superseded by FINRA. So the FINRA takeover, basically what it did is it transitioned all of the IM-rules into the FINRA series rules. These are the 4 categories we have here. We have 7100, ADF 6200, ADF 7530 deleted, and then 7500 charges for alternative display facilities, services, and equipment. Next episode we're going to go into these in more depth. This one I just wanted to point out the differences between the old rules and the new rules. So just going off the title, the old rule, IM 2310-2, was titled Fair Dealing with Customers. And it says right here, this rule is no longer applicable. NASD IM 2310-2 has been superseded by FINRA Rule 211. Now if we go look at 211, the title of it changes to suitability, so a lot less vague for what they're trying to do. Now if you look at the rule language itself, this is what's found at the top of the old rule. This is what's found at the top of the new rule. Basically, in the old rule, it had very clear language as to what an institution member could and could not do using this facility. And on the right-hand side, it's a more lackadaisical and allows for a lot more loopholes to be created. Now, on the old rule, you also had specific categories such as excessive trading activity, trading in mutual funds, fraudulent activity, fictitious accounts, discretionary accounts, unauthorized transactions, misuse of customer funds, etc. Now, in the new one, you get a couple of excuses. The first one being the reasonable basis obligation that allows broker-dealers to act under a reasonable basis if they feel like they can make a decision on your behalf. Likely something you sign upon signing up for Webull and Robinhood and trading apps like that. Same thing for quantitative suitability. This requires a member or associated person to have reasonable basis for believing that a series of recommended transactions, even if suitable when viewed in isolation, are not excessive and unsuitable for the customer when taken together in light of the customer's investment profile. Basically, it gives them more leeway to do what they wish with our accounts. Now look at this one. IM 2110-2, trading ahead of customer limit orders. Now of course this one was superseded as well by FINRA Rule 5320, and 5320 was renamed Prohibition Against Trading Ahead of Customer Orders. Looks good. However, this version is valid from May 8, 2019 through August 31st, meaning this rule is likely to change again. For better or for worse? Not sure. We're going to look into that next time. Now, if you look at this version, the current one that's open, section 0.02, no knowledge exception, listen to this. With respect to NMS stocks, as defined in Rule 600 of SEC Regulation NMS, if a member implements and utilizes an effective system of internal controls, such as appropriate information barriers that operate to prevent one trading unit from obtaining knowledge of customers' orders held by a separate trading unit, those other trade units trading in a proprietary capacity may continue to trade at prices that would satisfy the customer orders held by the separate trading unit. That is horrible. What caused all this? Well, they actually went through and they changed the rules governing the ADF facility in SR FINRA 2013-053, something else we're going to look at next time. Continuing on with the rule differences, continuing on with the participants, check this out. So you're all wondering how ADF has anything to do with GameStop and AMC? Well, it actually does quite a bit. You know why? These are the only active ADF participants under the FINRA website. Now, they say trade reporting only, but the Bloomberg terminal I'm going to show you in a second debunks that easily. So the two active ADF participants are no other than Jane Street and JP Morgan Securities, both of which have puts, calls, and shares for both GameStop and AMC. Here's the excerpts right here for JP Morgan Securities. They have AMC, they have GameStop, and they have GameStop shares. They also have AMC puts as well, AMC calls as well. So yeah, imagine that. Two of the most corrupt entities in the market are the ones that are active. Now there could be more, because obviously we don't know much about this facility and they don't tend to report accurate info regarding it. However, check out this Bloomberg. So this is for GME. I don't have access to AMC Bloomberg. If someone out there does and they'd like to share with us so we can compare data, that would be much appreciated. But check out the #1 holders for puts. We got Simplex Trading, Susquehanna, Jane Street, #3, Citadel, #4, of course, and amongst others. Now check out the call side. Look who's #1. Jane Street, #2, Susquehanna, #3, Citadel. And we got Simplex at #5. So the top 5, Jane, Susquehanna, Citadel, Group 1, and Simplex, are the same top 5 in both of these, just in different orders. Interesting, huh? Last but not least, check out, this is, by the way, this is data for yesterday, the 1st of July. Check out the #1 volume for GameStop. FINRA ADF by a freaking metric boatload. Almost triple. No, I'm sorry, almost just about double from the #2 being the EDGX. So there you go. ADF, proven by Bloomberg to be the #1 volume holder for AMC or for GameStop. AMC, not sure, but I would imagine the same thing applies. What do y'all think? ADF, not good, right? Next time, we're going to take a look into the FINRA sections of the rules. We're also going to take a look at that filing that came out that changed the rules altogether. Getting crazy. Down the rabbit hole.